Hey, what's up guys? Welcome back to the channel. I hope you're all doing well. The first stock we're going to talk about is Metro, ticker symbol MRU. Metro recently unveiled their 2022 to 2026 corporate responsibility plan for its food and pharmacy businesses. This plan essentially builds on the approach that has made Metro so successful and a pillar of consistency. It reflects Metro's ability to keep up with the changing business environment that has significantly evolved over the recent years. This plan paves the way for Metro to deliver on its ESG ambitions, sustainable development, and a commitment to its shareholders and its employees. Taking a look at Metro stats. The stock is currently trading around $64 a share. It has a market cap close to $15.5 billion, a dividend yield around 1.6, and a 5-year dividend growth rate of 7.7%. In the last 1 year, the stock has gone up 12%, and the last 5 years, the stock has delivered a 5-year performance of over 60%. When you take a look at the analyst recommendations, you'll notice that it has a very solid buy rating of 2.7, with 5 analysts calling for a buy on MRU. And considering the current price is not only less than the average price, but also less than the lowest price target, meaning there is potential for significant upside for capital appreciation. So when you take a look at Metro in a nutshell, dividends, check. Capital appreciation, check. You know exactly why this is a buy. Metro recently reported their Q1 2022 results, and they delivered strong performance and growth across the board. Sales were up 7.1% versus 2020. Food same-store sales was up 8.5% versus 2020. And pharmacy sales were up 9.1% versus 2020. These are some amazing year-over-year growth stats and should make investors very, very happy. And the best part is for all you dividend investors out there, they have increased their dividend by 10% for the next year. That's amazing. As we just saw, Metro has delivered some impressive growth results, and it's mainly driven by growth in their top line sales and on top of record sales last year, along with very good expense management. Metro operates Canada's third largest grocery chain, and they delivered record healthy profits all throughout their last fiscal year. That's very impressive considering all the challenges that are facing supply chains. Some of those challenges include terrible weather in many of the world's major farming regions, combined with ongoing supply bottlenecks due to COVID-19. This also caused grocery prices to surge 5.7% in December just compared to a year earlier. This marks the biggest increases facing grocery prices since 2011. Those are not the only challenges facing groups like Metro. The latest variant of Omicron has sparked flash labor shortages across the economy, and this is only adding to the difficulty of sourcing quality ingredients for grocery stores. Yet Metro's chief executive has insisted that his company is finding ways to keep stores adequately stocked. The company has invested heavily in keeping COVID-19 out of its stores and has rewarded employees with pandemic pay bonuses. In fact, Metro is using its profit as a cushion to absorb some of the higher costs from food producers, almost acting as a firewall between elevated wholesale prices and the prices consumers pay at the register. And that's why Metro is considered to be an investor's darling. Not only does it deliver on results for shareholders, but it also looks out for its employees and the communities in which it operates in. However, certain labor groups are calling on Metro to do more for its employees. Let me know in the comments, what are your thoughts? Do you believe Metro is doing enough for its employees, or can it do more? When it comes to stocks and taxes, it can get quite complicated. How much taxes do you pay on capital gains? And what about taxes on all those dividends you've been receiving? What are eligible dividends? What about those dividends that you receive from US companies? How do you track and report all this so that way you're not misreporting to the CRA when it comes to tax season? This tax season, I want you to take away all the headaches and all the worries when it comes to dealing with the CRA and just rest easy with Cloud Tax Pro. You can have your taxes filed with a pro and have it done all online without ever leaving the comfort of your own home. You get help every step of the way, unlimited support from real tax experts. Plus, you can store all your receipts and documents with Cloud Receipts. And the best part, year-long tax support even after you file in case the CRA comes knocking. So make sure you check out the link in the description for a headache-free, a hassle-free, a worry-free tax season. Next stock up is Magna International, ticker symbol MG. Magna is the third largest auto component supplier and third-party auto manufacturer, catering to names like Toyota and BMW. It is well positioned and well placed to benefit from the rising trend of electric vehicles and autonomous vehicles. According to research reports, the EV or the electric vehicles market is expected to increase at a CAGR of 24% through 2028. With the industry growing at 24% annually, stock market leaders like Magna are looking to surpass industry growth. The stock is currently trading around $90 a share, and they have a market cap close to $30 billion. They have a dividend yield around 2.2% and a 5-year dividend growth rate of 11.5%. That's a great combination of dividend yield and dividend growth rate. I just love seeing those double-digit dividend growth rates. It just makes me happy. In the last 1 year, because of the stock market volatility, the stock has only moved 2%, but zooming out to 5 years, the stock has gone up 75%. And when you take a look at Magna's analyst recommendations, Magna is one of those rare dividend growth stocks where you'll see such a strong buy rating at 1.9, with 16 analysts covering this stock calling for a buy or a strong buy. Honestly, I can't say I'm surprised, given its growth prospect as a market leader and the current stock trading price going for less than the lowest price target. This stock is an absolute steal at the current valuation. If I see the stock for trading at around $100 a share, I'm definitely backing up the truck and just loading up on those shares. If you've heard of the company behind the iPhone, I believe they go by the name Apple, they outsource all their manufacturing to a company called Foxconn. Just think of all the volumes of iPhones that are sold every year, year after year. That's bank for companies like Foxconn who actually manufacture those iPhones. So why am I talking about Apples and iPhones and Foxconn for a segment on Magna? Because Magna has the potential to become the Foxconn of electric vehicles and autonomous vehicles. In just the last decade or the last 10 years, this stock has delivered a 500% capital appreciation. Or simply put, that's a 5x growth. But it has even a stronger growth potential coming in the next 10 years as it rides the electric vehicle wave and the autonomous vehicle wave. The automotive industry did face major setbacks as there was a semiconductor shortage, especially in the second half of 2021, which is why the stock was dragged down by 23% because of the supply shortage. And that's why this is such a good time to buy the stock before it becomes too expensive. The majority of the growth will likely come in the next 2 to 5 years as the EV momentum just ramps up. Most of Magna's products will be equally or more valuable with a shift to electric vehicles. Investing in electrification is a major part of the company's growth strategy. I would even say it's vital to Magna's future growth existence, because there's no secret that hybrid and electric vehicles are the future face of the automotive industry. If you want in on the electric vehicle boom without the worry of picking unknown stocks, then I would highly consider Magna as your go-to option. Magna has kicked off the new year, reinforcing its capabilities to produce electrification solutions that deliver the vehicle of the future and greater sustainable mobility for all. This tech combines Magna's battery technology along with its e-beam technology, paving the way for electric pickup trucks. By the way, if you're new to the channel or you've seen my content before, do me a huge favor, hit that like, subscribe, and thanks button, because it lets me know to produce more content like this and you don't miss out on future stock picks. Next stock up is InterRent REIT, ticker symbol IIP.UN. Let me ask you this, is it possible to capture the gains from Canada's hot housing market without owning a single property? What if you capture those gains with multiple properties and no down payment? In fact, you could start with less than $20. This is where InterRent REIT comes into play and is an excellent opportunity to benefit from Canada's hot housing market. In the last 10 years, this REIT has delivered an impressive growth rate of over 840%. If you analyze that, that's 25% per year. That's amazing considering the entry point is less than $20. Let's take a look at its stats. It's currently trading around $15 a share and has a market cap close to $2.2 billion. It has a dividend yield of 2.2% and a 5-year dividend growth rate at 8.6%. It's not quite double digits, but I'll take it. In the last 1 year, the stock has gone up 6%, but in the last 5 years, this stock has gone up 116%. Taking a look at the analyst recommendations on InterRent, it has a very solid buy rating at 2.3, with 10 analysts giving this either a buy or a strong buy rating. It's trading for less than $16 a share, and that's a bargain considering the value and dividend growth potential you're getting with this REIT. You get access to super high quality residential assets across the country, and a growing dividend along the way. This is a perfect way to be a hands-off landlord and collect your dividend payment each and every month. One of the biggest issues facing Canada's economies over the last few years is the unaffordable housing market. For years now, the rapid rise in housing prices has continued to make headlines, as affordability continues to be a bigger and bigger issue for more and more people. Luckily for investors though, if you want an easy way into Canada's real estate sector, you can pick up shares of InterRent. There are many benefits of buying real estate stocks, especially the fact that you hardly need any capital to begin with before you put your money to work. Real estate stocks offer a ton of flexibility for Canadians, a diversified portfolio, and a professional management team that operates the business for you. So whether you want to invest in the real estate market or are just trying to keep up with the rapidly rising housing prices, this is one of the best residential real estate stocks you can buy in the country. In fact, InterRent ranks number 1 among 6 Canadian REITs that are considered to be the most consistent dividend growers since 2014. And based on InterRent's FFO since 2011, it has produced a 10-year CAGR of over 14%, while its distribution in that same timeframe has grown over 10% CAGR. Both of these metrics have far surpassed inflation, and that's why it's so important and so crucial that your money is invested in the right growth assets, And it isn't just sitting there in your checking account earning nothing. Looking at InterRent's portfolio, it has close to 13,000 income generating suites in three of the most populous provinces in BC, Ontario, and Quebec. Average monthly rent collected across the portfolio has also grown consistently since 2017, with an average growth rate of over 5% year over year. And most recently, it has an active development in the nation's capital, expected to be completed in Q4 2022, bringing on an additional 158 suites of income generation to its portfolio. This REIT has all the right pieces to be a long-term holding. Long-term growth potential, exposure to high-quality assets, and a very strong monthly growing distribution. Next up, Waste Connections, ticker symbol WCN. Waste Connections is one of the largest waste management companies throughout North America. It has an impressive presence in the United States at 44 states and counting, and in Canada, 6 provinces and counting. It serves well over 8 million individual and business customers. It has an asset base of over $14 billion, which includes vehicles, dump sites, and waste processing facilities. Take a look at its stats. It's currently trading around $155 a share and has a market cap close to $40 billion. It has a dividend yield of 0.8% and has an amazing 5-year dividend growth rate at 14.9%. In the last 1 year, the stock has gone up 20%. In the last 5 years, it has gone over 121%. Take a look at the analyst recommendations on WCN. You won't see many companies given a consensus buy or strong buy rating. WCN is a very elusive company with a very strong buy rating of 1.8. And with the current market volatility, the stock is currently trading around the low end of that price range target. The stock is just an amazing pickup at the current valuation. WCN is a very financially healthy company. Just take a look at its revenues and free cash flow. This is a growth company that has delivered healthy profits for its shareholders. In just the last 10 years, it has delivered a 4x return to its investors. And thanks to the nature of its business, it'll just keep on growing in both the good and the bad economic times. Just think about it. Humans will continue producing waste no matter what's happening in the economy. The company also benefits from lower competition as it operates in secondary or very elusive markets. Not only has WCN outperformed the TSX over the last decade, but has also beaten the S&P 500 over the exact same period with a large margin. The company is also focusing on its ESG efforts with a $500 million commitment towards achieving its long-term targets, which includes a growing pipeline of renewable gas and resource recovery projects. The company is also looking to future-proof its operations by looking at things like AI-driven next-generation truck camera systems and enhanced safety features throughout its fleet designs, along with robotics at recycling facilities, making well use of that $240 million worth of acquired assets throughout 2021. One key factor that makes WCN so reliable is its diversified revenue streams within the waste services industry, which includes commercial, residential, and landfill segments, all contributing to very healthy revenue growth. Taking a macroeconomic view, improvements in economic activities combined with an economic expansion will only further drive demand for WCN services in the waste management business. Next up, Questrade, ticker symbol ATD. This is one of the best value and dividend plays available on the TSX. It's a leading convenience store operator in North America with a heavy global presence. And investors may note something very interesting about ATD's stock recently. It no longer has a .A at the end of its ticker symbol. And that's because the company recently put an end to its super voting rights for its founders. But before we dive deeper into that topic, let's take a look at its stats. It's currently trading around $50 a share and has a market cap close to $53 billion, a dividend yield of 0.9%, and a super healthy 5-year dividend growth rate at 15.8%. In the last 1 year alone, the stock is up 27%, and in the last 5 years, the stock is up 55%. ATD has a very solid buy rating at 2. It is an exceptional value and dividend play with the current trading price going between the average and the low price target. Honestly, I just love the combination of a value play along with a dividend growth play. ATD is one of the largest companies that actually had a super voting rights structure, giving its 4 founders 10 voting rights for every single stock they own. This super voting right ended when the last of the 4 founders turned 65 late December 2021. So why does this all even matter? When voting rights are disproportionately held by just a few investors, the amount of say other investors have in determining the direction of any given company is greatly diminished. And many institutional investors may not want to touch a company where they don't have a fair say in the company's business due to special voting rights. And now with a revamped voting structure, this company overnight has become a lot more attractive. This is a global company operating in 26 countries and territories with close to 14,200 stores and has a well-known brand and reputation. And that's why I'm so glad they got rid of the special voting rights. It now makes the voting more fair and more equitable across for all investors. Not to mention, this is also a recession-resilient business where it has managed to grow its convenience store sales during the last 2 recessions. And it's a business on growth mode. Since 2004, ATD has successfully completed 64 deals, adding over 10,000 stores globally. It's currently aiming to deliver EBIT-based return on capital employed at more than 15%. And when it comes to CapEx or capital expenditures, it's currently aiming to maintain that level of capital expenditures around 35 to 40% of EBITDA. With a greater focus on the offerings and customer journey, this is expected to drive the next phase of its organic growth. The company's balance sheet is in great shape, even though it has faced many challenges in the current acquisition environment. I believe it has plenty of opportunities for further consolidations, for further growth, driving dividends for investors. Did I miss a stock that you think I should include? Let me know in the comments section. Thank you so much for watching. Make sure to check out all the links in the description to support this content and future content. And I'll talk to you in the comments section.